Refinancing risk is another danger associated with refinancing. It refers to the possibility that you will not be able to replace your existing debt with suitable new debt when you need to, due to factors beyond your control, such as rising interest rates or a shrinking credit market. Any individual or company can experience refinancing risk, either because their own credit quality has deteriorated or as a result of market conditions. To mitigate refinancing risk, it is important to plan ahead for a scenario in which new credit is difficult to obtain at an attractive interest rate or impossible to obtain at all. So in this video, we are going to discuss what are the dangers of refinancing. The video is going to be amazing. Make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. Refinancing a mortgage can be a good idea if you have a clear financial goal, such as reducing your monthly payments, paying off your loan sooner, or dealing with a financial emergency. However, there are also several bad reasons to refinance, such as consolidating debt, growing new credit card balances, or paying more over time due to fees and closing costs, a longer loan term, or a higher interest rate. Every time you refinance, you'll pay closing costs and fees, which can take years to recoup, and your credit score will be pulled by lenders, which can affect your creditworthiness. To consolidate debt. Debt consolidation is often a good thing, but it has to be done right. In fact, debt consolidation done wrong can end up being one of the most dangerous financial moves any homeowner can make. On the surface, paying off high-interest debt with a low-interest mortgage seems like a smart move, but there are potential pitfalls. One pitfall is that you are transferring unsecured debt, such as a credit card, into debt that is backed by your home as collateral. If you are unable to make your mortgage payments, you can lose that home. While non-payment of credit card debt can have negative credit score consequences, they are usually not as dire as a foreclosure. Another pitfall is that many consumers find that once they have repaid their credit card debt, they are tempted to spend again and will begin building up new balances they will have more trouble repaying. This is because they no longer have the discipline of having to make monthly payments on their credit cards. Finally, debt consolidation can be expensive. There are often fees associated with consolidating debt, and the interest rate on a debt consolidation loan may be higher than the interest rates on the individual debts being consolidated. If you are considering debt consolidation, it is important to do your research and understand the risks involved. You should also make sure that you have a plan in place to avoid falling into debt again. To move into a longer-term loan. While refinancing into a mortgage with a lower interest rate can save you money each month, it is important to consider the overall cost of the loan. For example, if you have 10 years left to pay on your current loan and you refinance into a new 30-year loan, you will end up paying more in interest overall. This is because you will be paying interest on the loan for a longer period of time. Additionally, you may be required to pay closing costs on the new loan, which can add to the overall cost of the refinance. Your lender may also disqualify you from refinancing your mortgage if you carry too much debt. This is because lenders want to make sure that you can afford the new monthly payments. Your debt-to-income ratio is a measure of how much debt you have compared to your income. If your debt-to-income ratio is too high, your lender may not approve your refinance application. Finally, having a low credit score may also prevent you from refinancing your mortgage. This is because lenders use your credit score to assess your risk as a borrower. If you have a low credit score, your lender may believe that you are more likely to default on your loan. As a result, they may charge you a higher interest rate or deny your refinance application altogether. If you are considering refinancing your mortgage, it is important to speak with a lender to discuss your options and determine if refinancing is right for you. To save money for a new home. As a homeowner, you need to make an important calculation to determine how much a refinance will cost and how much you will save each month. If it will take 3 years to recoup the expenses of a refinance and you plan to move within 2 years, that means you are not saving any money at all, despite the lower monthly payments. Using a mortgage calculator is a good resource to see what a different monthly payment might look like. To switch from an ARM to a fixed-rate loan. For some homeowners, this can be an excellent move. particularly if you intend to stay in the home for years to come. But homeowners who are simply afraid of the bad reputation of an adjustable rate mortgage, ARM, should carefully look at their terms before making a move to refinance. If you have an ARM, make sure you know the index to which it is tied, how often the loan adjusts, what the caps are on loan adjustments for the first cap, annual cap, and lifetime cap. It may be that a fixed-rate loan is better for you, but do the math before committing to spending money on a refinance. Mortgage lending discrimination is illegal. If you think you've been discriminated against based on race, religion, sex, marital status, use of public assistance, national origin, disability, or age, there are steps you can take. One such step is to file a report to the Consumer Financial Protection Bureau or with the U.S. Department of Housing and Urban Development. To take cash out for investing. This is not a good idea, even when the stock market isn't rocky. The problem with cash is that it is too easy to spend. If you are disciplined and will truly use the extra money to invest or build your emergency fund, this can be a good option. Paying down a mortgage at 4% per year can be a better deal than plunking your cash into a certificate of deposit that earns 2% every year. Make sure you are a savvy investor who understands both the risks and potential upside before playing with the equity in your home. To reduce your monthly payments. Reducing your monthly payments by lowering your interest rate makes financial sense, but don't ignore the costs associated with refinancing. In addition to the closing costs and fees, which can range from 2% to 3% of your home loan, you will be making more mortgage payments if you extend your loan terms. If, for example, you have been making payments for 7 years on a 30-year mortgage and refinance into a new 30-year loan, remember you will be making 7 extra years of loan payments. The refinance may still be worthwhile, but you should roll those costs into your calculations before making a final decision. To take advantage of a no-cost refinance. A no-cost mortgage loan is not possible, so be careful when you see such an offer. There are several ways to pay for closing costs and fees when refinancing, but in every case, the fees are paid in one way or another. For example, homeowners can pay cash from their bank account for a refinance, or they can wrap the costs into their loan and increase the size of their principal. Another option is for the lender to pay the costs by charging a slightly higher interest rate or including closing points. You can calculate the best way for you to pay the costs by comparing the monthly payments and loan terms for each scenario before choosing the loan that works best for your finances. It is important to note that a no-cost mortgage loan is not always the best option. In some cases, it may be more expensive in the long run to have the lender pay the closing costs. It is important to compare all of your options before making a decision. This was all for today. Hope you liked the video. Let us know your opinion in the comments section below. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.